Okay, let's unpack this. Welcome back to the deep dive.
Great to be here.
So our mission today is to really cut through the noise around crypto liquidity. We're going to focus on that one metric that's so complex, so contested.
TVL, total value locked.
Exactly. For years, TVL was, well, it was the scoreboard for DeFi, but the definition of that score, it's fundamentally changing.
It's changing in a big way.
Yeah, we're not just talking about anonymous money chasing yield anymore. We're looking at a future where, regulated stablecoins, certified institutional rails, modern messaging systems.
Like ISO 2022.
Right, and compliant DeFi are all converging. They're becoming this single unified financial fabric. Our goal is to understand why this conversation is shifting so dramatically.
And what really sets this new regulated infrastructure apart from, well, the speculative frenzy we saw in the past.
What's fascinating here is that TVL, its meaning has just expanded so far beyond money locked.
Oh, absolutely. As the sources define it, it's now a measurement of fundamental trust.
Trust, that's the key word.
It is. It represents confidence in the liquidity, real economic activity, developer demand, and this is the crucial part for the future institutional acceptance. If you're trying to track where global finance is going.
You're tracking this new kind of TVL.
You're tracking the flow of this new compliant institutional TVL.
Absolutely.
Yeah.
And the stakes couldn't be higher. I mean, we are talking about the infrastructure where the next $1 trillion in tokenized assets and regulated deposits will eventually settle.
Yeah.
So our goal today is to use the source material to analyze how one specific settlement, Hub XPR Network, which is powered by the Metal Blockchain, claims it was engineered for this exact purpose. To capture this massive flow.
Right. The whole conversation suggests we're moving out of a phase where blockchains were built for speculative returns.
And into what?
Into a phase where they have to be engineered for systemic regulated settlement.
Okay, here's where it gets really, really interesting. To get the scale of this shift, we have to contrast the two eras of DeFi TVL. Let's start with the old wave. That was, roughly 2020 to 2023?
Yeah, that period was marked by what the sources call, pretty bluntly, speculative liquidity. It was all built on these highly experimental and, frankly, sometimes reckless models.
What do you mean by reckless?
Well, think about hyperinflationary farming tokens, completely unsustainable yield cycles, and the rapid deployment of liquidity traps, or, as one source wryly puts it,
rug factories dressed up as revolutionary ecosystems.
Exactly.
So it wasn't just about chasing yield, it was a fight over who could farm the fastest, a fight over liquidity that was, just ephemeral.
Completely. And the history of that era is just marked by these reflexive spirals. Billions would flow in, lured by these crazy synthetic returns.
Only for billions to just evaporate.
Right. When the tokenomics models collapsed, the infrastructure wasn't built for keeping capital or for banking efficiency. It was built to inflate a narrative and push out tokens.
And if you dig into why they failed, the sources mention things like massive and permanent loss, stablecoins losing their peg, you realize the foundation was just structurally unsound.
Unsound for any real institution, yeah. But the sources are clear that starting around 2025, TVL is changing its shape completely. We're in the new wave now.
The institutional TVL, what the sources call real liquidity.
That's the one.
So who are these institutions? Who is actually driving this new liquidity? And what makes us think this money is actually going to stick around this time?
Well, we're talking about vast reserves finally coming into the digital economy. The sources give specific examples. Credit unions issuing their own stablecoins.
Compliance-focused ones.
Right. Major banks are playing with tokenized deposits, which are basically regulated liabilities on a chain. You have fintechs integrating these rails for speed and data.
And even legacy financial providers are migrating for efficiency.
And that integration of standards like ISO 2022 is key. It lets you attach so much more data to a payment, which makes blockchain settlement incredibly attractive to these incumbents.
So if you connect all those dots, the implication is pretty profound. This flood of regulated capital means the core design of the blockchain itself has to change.
It has to. It's not an option anymore.
Right.
You just can't onboard a huge credit union or a corporate treasury onto a system that was built from the ground up for anonymity and maximizing volatile yield.
The trust just isn't there.
It isn't. The trust needed to hold tokenized deposits has to be literally reflected in the code itself.
That makes perfect sense. So if this new wave of money is coming from entities who answer to regulators, what are their non-negotiables? Because they don't care about 100,000 transactions per second.
Not if there's a risk of systemic regulatory fines.
Exactly.
And that is the pivotal insight. The core demand is for ironclad institutional-grade compliance. The source materials are really clear on this. Every regulated entity requires robust, non-circumventable KYC and AML functionality.
And it has to be embedded right into the chain layer.
Right at the core.
We're talking about more than just a checkbox here, right? We're talking about compliance with things like the Bank Secrecy Act BSA compliance.
Which is the bedrock of U.S. financial reporting.
Yeah.
Plus, secure, federally compliant identity frameworks built right into the settlement rails.
Exactly. I mean, the BSA demands detailed record-keeping, mandated reporting, things that just do not exist on older, anonymous chains.
And this is why the sources claim that the specific architecture of the XPR network, powered by that metal blockchain settlement layer, was engineered for this exact mandate.
Hold on, let's pause there for a second. We need to clarify that relationship. XPR Network and Metal Blockchain, how do they fit together?
Good point. Think of Metal Blockchain as the foundational settlement engine. It's the compliance bedrock, the secure ledger where value actually moves.
Okay.
The XPR network, on the other hand, that's the interface. It's the execution environment and the app layer that users and devs interact with.
Because they work together.
They do, but Metal Blockchain provides that compliance foundation that makes everything else viable for a bank or a credit union. The claim in the sources is that no other L1 or L2 offers this specific level of readiness.
Why not? I mean, what about some of the enterprise Ethereum forks? What's the core differentiator?
It's about how they were built, the prioritization. Most chains tried to, bolt compliance onto a design that was already anonymous.
An afterthought.
It was an afterthought. The Metallicus team, though, they built the opposite path, which raises the question, what did they prioritize, if not high-speed anonymity?
So tell us about that core design philosophy.
They built the chain around what real TVL needs. So the priorities were regulated first, identity first, banking first, enterprise first, and stablecoin first.
Not a secondary feature.
No, it was the foundation. By making identity and compliance mandatory at the settlement layer, they ensured the system is just inherently auditable and legally sound from day one. And for moving massive regulated capital.
That's the only thing that matters.
It's the non-negotiable requirement.
That shift is key, from chasing speculators to absorbing regulated entities. It's like building the armored vault before you invite the central banks over.
That's a great way to put it.
So where is this liquidity actually flowing now? We know that where compliant stablecoins go, TVL follows.
Right, and the sources point directly to the metal dollar, or XMD, ecosystem. It's positioned as the key liquidity bridge.
The compliant pipeline currency, you might say?
That's exactly it. It's becoming the necessary intermediate asset for a whole range of institutional funds.
What makes XMD special in that role?
It acts as the compliant conduit for fiat moving on-chain. It serves credit union stablecoins, bank-issued tokenized deposits, all these crucial settlement rails. Because the settlement layer enforces KYC-ML.
It can interact with regulated capital in a way anonymous stablecoins just can't.
It's the compliant handshake. It's what's necessary for the funds to even enter the digital ecosystem.
And if we look at the potential growth here, the sources are not shy. This isn't just a white paper concept.
No, not at all. We're already seeing major growth. The sources cite specifics, like over 20 credit unions in the pipeline. Yeah, plus numerous fintech platforms, payments providers, corporate treasury pilots. They're all actively integrating these rails.
And if you add all that up...
If you combine all those initiatives, the source projects a pipeline of trillions flowing into the Metallicus ecosystem over the next decade.
That's the scale of institutional migration they're planning for.
Trillions. To handle that, though, you need more than just settlement. Money has to do more than just sit there. It needs to earn.
And that's where the upcoming infrastructure comes in. The Metal L2.
Okay.
It's a layer 2 built specifically for deploying and locking that liquidity, and it's designed to be compliance-aware from the get-go. It's targeting the key areas institutions want on-chain efficiency.
So regulated DeFi pools, compliant DEX.
Exactly. Yield markets that meet specific risk rules, and the really hot area of real-world asset tokenization, RWA.
That's where the long-term sticky TVL lives.
Tied to actual economic value, not just speculative token emissions. Yes. It's an incredibly confident strategy. And speaking of confidence, the source highlighted a very specific message. The meme posted by @XPR Network.
All your TVL are belong to us.
Yeah.
What does that signal?
It's not just playground talk. It's a strategic signal based on what they see as their technical superiority for their target audience, the institutions.
So they believe they've solved the biggest bottleneck.
Regulatory compliance and identity, yes. The declaration signals that the next era of liquidity won't be hype-driven. It'll be driven strictly by compliant, real-world adoption, and because they built their infrastructure for those requirements.
They believe it'll just naturally absorb that flow. They're claiming ownership by design.
Precisely.
So what does this all mean for you, the listener, following along? We've established TVL as a measure of trust, and the focus has shifted from, unsustainable farming to compliant real-world finance.
And that point about risk is so important. For an institution, the risk isn't just losing funds.
It's the risk of massive regulatory fines.
Which is why compliance is the ultimate asset protection. So the synthesis is clear. The final destination for the majority of global liquidity, trillions in deposits, stablecoins, settlement flows, is on-chain.
It is. But most legacy chains, the ones built for speculation, will never see this flow. They just don't have the identity and compliance frameworks.
They're fundamentally incompatible with regulated finance.
Completely.
And this brings us right back to the metal blockchain philosophy. They built the opposite path.
Regulated first, identity first, banking first. They made sure the infrastructure was ready for these massive reserves of capital.
So the ultimate conclusion from the sources is that XPR Network isn't chasing TVL.
It's absorbing it, the real-world TVL. And that absorption happens organically as stablecoins migrate, as institutions tokenize assets, and as the digital banking network comes to rely on this one hub for legal certainty.
So that message, trillions, it's not presented as a dream.
No, it's presented as the logical conclusion of their regulated first design.
That is a compelling assessment of the shift in decentralized finance. We've covered the distinction between speculative and institutional TVL, the necessity of regulated rails like KYC and AML, and XPR Network's unique positioning. Thank you for joining us for this deep dive.
My pleasure. And as you're thinking about this massive transformation, here's one final thought to explore on your own.
Go on.
If the core value of this next financial wave is truly compliance, how will the lack of identity on older, purely decentralized chains force them to either evolve dramatically or be relegated purely to servicing what's left of the speculative, non-compliant market?